Hello everyone, welcome back to another video. Myself Teja. Today in this video we are going to start a new series, that is accounts. In this video we are going to take a closer look about basics of accounts and process of accounting and 5 elements of financial statement. So let's get into the video. Basics of accounting. What is accounting? Summarizing the financial data into meaningful format. In a company, n number of transactions will happen in a day. So the financial data, the transactions between the company and the X person are known as financial data that will be converted into meaningful format. The company owners will see the final result. The final result will be in the form of two types: balance sheet and profit and loss account. Based on this, the company owners or shareholders will take decisions in company so that they can improve the production sales rate. Okay, now accounting process contains bookkeeping means starting of the bookkeeping is source means if a company buys raw material from the X person will give a bill. The receipt will be given. It is a proof that the company has bought the following goods from him. So the bill is known as the source, and then it will be converted into journal entry. From the journal entry we will post ledgers, and from that we can divide the trial balance. From trial balance we can find the profit and loss account and balance sheet. This is a basic video, so we are not going to do any problems about journal and ledger. 5 elements of financial statements. The accounts is based on the 5 elements, that is expense, revenue, assets, liabilities and capital. First, profit and loss account contains expense and revenue. Profit and loss account shows us how much expenses in a year the company has done and how much revenue the company has generated. And balance sheet shows how many assets are there, how much the durability of the assets, and how many liabilities the company have, how much money they have to pay. The company should pay money to the outsiders for taking rent or taking rent of any machinery or land. They have to pay some money to the outsiders, so that is known as liability. Expense. An expense is the cost of operations that a company incurs to generate revenue and from which no further benefit is expected. An expense means expenditure. If at the end of the month we will pay rent, it means we have we have taken benefits from the room or a place, and we have paid the amount to the owner. Are we going to expect any benefits from the land again? No, because we have to pay one more month amount to take benefits. So expense means we have already taken the benefits from the on which we are making the expense. Revenue. It is the gross inflow of cash, receivables, or the consideration of arising in the course of ordinary activities of business, such as sale of goods, rent received, rendering the services, etc. Revenue means the cash or the money which is generated or coming into the business. If we give land for rent, the people who take the land for rent, they have to pay some money to us, so that the rent paid from them is known as revenue. Sales of goods. If we sell some goods, the revenue collected from the sales of goods is known as revenue. Okay, anything that which comes into our business is called as revenue. Assets. An asset is a resource controlled by an entity, not the point, An asset is the resource controlled by an entity as a result of past events and from which future economic benefit are expected to the flow to the entity. Here I want to explain with an examples. A company buy a system and take and rent a system. If they taken rent, they have paid something to take rent. Okay, they have paid something to take rent. If they brought the computer, they have paid full amount. The computer is owned by the company. Computer from for rent basis, also for a limited time it is under control of the company, so it is considered as asset. Read this point. An asset is a resource controlled by an entity. As we can see, computers will work to 3 to 4 years, so these both computers can give future benefits to the company, so the both are considered as assets of the company. Okay, now next, liability. At present at present obligation of the entity to transfer an economic resource as a result of past event, it is a claim of outsiders on total assets of the company. Liability means the amount we have to pay for the outsiders, or we have taken goods from them and we didn't pay them, so we have to pay money, so it becomes a liability for us. And if we taken a rent for a land from them and we didn't pay the rent properly, so the rent payment will be deducted from the revenue, so it is a liability for us. Pay to the outsiders means from whom we are taking benefits, they are known as outsiders. So the outsiders have claim on our total assets of company. They will have first claim because every company wants to finish their liabilities. Any company doesn't want to make more and more liabilities because it's a loss to the company. So the company wants to finish the liabilities as soon as possible. Capital. Capital is the money invested by the owner of the company. The amount of money invested by the owner of the company is known as capital. Every year we get some revenue. In that revenue, the capital is deducted so that the capital is added to the next year. So it is a claim of owners in the total assets. The owners will have claim in the total assets because they have invested in the company. Thank you for watching. Like and share this video. For more interesting videos, please subscribe our channel and don't forget to check it out our social media links. So let's meet in the next video.